Okay, folks, so a lot is going to be happening in the next 72 hours. Number one, we have the Fed's FOMC meeting happening Tuesday and Wednesday. Wednesday, the official rate hike decision will be announced. Then we have the GDP report for Q2 officially out. And of course, we have an extremely busy earnings week, arguably the most important week of this entire earnings season, with everything from mega tech to manufacturing and consumer cyclicals reporting. If there's a week to pay attention, this is the one, folks. Timestamps below, we're going to get to work after a quick plug. If you're looking to get up to 10 free stocks valued all the way up to $2,500 when you sign up with Moomoo using our link down below, make sure to do so as soon as possible because the deal expires July 31st. Great promotion and a pretty damn good ROI to try out a free trading app. Worst case scenario, you don't like them and you can withdraw your stocks and move somewhere else. But they're betting that you're going to like them quite a lot and are going to stay with them, which is why they're giving you so many free stocks. Okay, let's get to work. So let's start with this FOMC meeting. So on Wednesday, we will get the next rate hike decision and the newest economic projections coming from the Fed. Right now, Fed futures are forecasting an 80% chance of a 75 basis point hike instead of what they were projecting after the latest CPI report, which was a 100 basis point hike. This is a big damn deal because markets are now expecting the Fed to start slowly being less and less aggressive on its fight against inflation, which to me sounds like the opposite of what they want to be doing. They want to make sure that inflation is nipped in the bud before they start being less aggressive. But markets are indeed expecting a less and less aggressive Fed policy trajectory as we head into the fall. And in fact, if you look at the data, they are actually expecting each meeting to be less and less aggressive than the previous one. Right now, markets are again factoring in a 75 basis point hike for this coming meeting on Wednesday. But you look at the September meeting, which is of course in September, well, the highest probability target rate for that meeting is 275 to 300 basis points. And if we get the 75 basis point hike this week, that means the markets are only expecting a 50 basis point hike in September. So you're cooling down from 75 at this meeting this week, and then 50 in September. And then look at what they say at the meeting after that in November. They are assuming a near equal chance of a 25 basis point hike or a 50 basis point hike. So we are quickly switching from, oh, we're going to attack inflation heavily to now we're going to really cut back on the attacks. And here's where it gets crazy. The December meeting's highest probabilities are for the 300 to 325 basis point range to the 325 to 350 basis point range. Some people think it's going to go as high as the upper end range at 375, but still overall, the vast majority of participants in this market are thinking that, hey, the biggest Fed hikes are actually behind us and the following meetings are going to be less and less aggressive. And it's going to peak somewhere around the November or December meeting, which kind of backs my thesis that I talked about last week where the Fed has kind of flipped. The Fed talked about responding to increased inflation in the present by raising interest rates faster to combat rising inflation. But now they're kind of signaling, hey, we're okay with heightened inflation. We think it's going to cool down a little bit and that's enough for us. But we want to start being a little bit less aggressive so that we can kick the can down the road on this overall tanking of the economy. You go back to the futures projections from the Bank of America survey, people are expecting rate cuts to start in 2023, right? And so we must pay very close attention to what happens this week because what the Fed has been guiding so far is essentially the de-escalation of this fight against inflation, which to be completely honest with you, I think that's an incredibly big gamble because if we go into the later stage of fall and all of a sudden you get to the situation where energy prices and commodities overall start skyrocketing or have barely cooled off, well then you get into the situation where we're deep in a stagflationary environment and the Fed has to really douse the flames of inflation while the economy is not nearly as strong as it is today. So pay very close attention to what they are seeing, what they are projecting, and what they are doing. If the Fed decides to increasingly take the foot off the brake, the biggest worry for the stock market is no longer going to be the Fed, it's going to be the actual earnings recession that we're likely going to be heading into deep into the fall. I mean, we're already kind of in a deep earnings contraction, so I don't want to say, oh, deep in the fall, we're going to have an earnings recession, because it's kind of like, hey, we're sort of already in it. Speaking of earnings, let's go ahead and get into it. So I don't really give a hoot about Monday or Friday, some players reporting, but I'm not really watching that. From Tuesday to Thursday, though, you are going to see all hell break loose. Demons everywhere. On Tuesday before open, you have UPS, Coca-Cola, GM, General Electric, McDonald's. After close, you have Alphabet, Microsoft, Visa. So with UPS, you have a big leader in shipping and receiving, and of course, supply chain health overall. We're going to get a good update on that. Coca-Cola, of course, represents the bottled diabetes trade and the overall diabetes trade. I know I make that joke every earnings season, but hell, if it isn't true. But very important company because this is perhaps one of the most core consumer defensive companies that tends to be able to price on or pass on its pricing pressure to consumers quarter after quarter better than most other players. Obviously, they don't just have bottled diabetes, they also have bottled water, which in many ways is actually more of an insult to the consumer than bottled diabetes, because at least when you have to make bottled diabetes, like you're making some sort of product. With this other one, you're just bottling water. Oh, I guess we kind of cleaned it, huh? GM representing American automotive manufacturing and figurative Tesla tailpipe swallowing. I say figurative because, well, Teslas don't have tailpipes. But hey, outside of GM's lackluster EVs, they do have a pretty solid lineup of brands outside of that, and I want to see an update on their manufacturing specifically and profit margins associated with that. Obviously, McDonald's reporting the same day as Coca-Cola, adding to the overall diabetes trade. And then, of course, we have to talk about the big dog Alphabet, which is going to be watched very, very closely. This year is the year of disappointing economic growth and conservation of capital, and companies not wanting to spend money to do customer outreach anymore, which has been a complete disaster to anybody in the ad spending business. And that's, of course, Alphabet's main and primary profit driver, right? Snapchat reported earnings last week that reported more than anticipated active monthly users, but their ad spending monetization model is getting completely hammered. People right now do not care how many eyes your platform can reach. It's all about how much demand you are seeing on ads, and quite frankly, Alphabet is the biggest player. And there have certainly been some signs in the overall industry and the previous earnings reports that really suggest that Alphabet is slowing down quite a bit. With Google, I mean, you've already heard they are starting to pause hiring, and there's talk of consolidating various investments and projects. There's a reason that company after company is becoming more cost efficient and restructuring right now, and that is because they are not so subtly hinting that we are heading for a massive, massive period of uncertainty at the very best. And even companies that are as well capitalized and as resilient as an Alphabet are noticing that, and they are prepping. And the fact that Google and parent company Alphabet have come out and already suggested that they're starting to do some of these cutback measures is incredibly telling. They want to make sure that when the earnings report comes out, people aren't shocked, right? They're guiding expectations. And you think about what it means when companies like Alphabet start cutting back. I mean, 2021 was a year that advertising revenue on Google jumped insanely fast. People think it's 2020 when all the lockdowns kept everybody at home. 2021 was actually when the consumer boom happened. And you could see this massive boom as people felt very stimulated, but they also felt a lot more certain about their future, or at least confident to spend. But now we're in a completely different situation. Advertisers are taking a moment and looking at themselves in the mirror and asking themselves, hey, wait a second, why are we going to spend all this money to advertise to consumers that are more broke than ever, are leveraged to the hilt, and quite frankly are not very interested in our products anymore because they have to pay so much more for their daily living items like, I don't know, gas or basic food items, Pop-Tarts. If you have to spend half your monthly salary on stale Pop-Tarts that didn't taste good brand new, then all of a sudden you're not as appealing to advertisers, right? And according to a Wicked report, 64% of ad spending in the US is on internet ads. So if Alphabet does report a pretty broad decrease in ad spend and customer outreach, that is pretty damn telling for the state of the current economy. Microsoft has been cutting job openings. What are their numbers and what are they going to be projecting moving forward? Visa has a lot of advantages. Of course, their percentage fee-based structure, goods and services become more expensive. Well, you're still making more money, right? So you're protected in that stance. But when consumer spending starts going down, which it should be starting to go down quite a bit when adjusted for inflation, then all of a sudden you see a pretty damn clear indication that we're heading in the wrong direction. Wednesday, you have Shopify representing e-commerce, Boeing representing manufacturing, then you got waste management, and then you got Hilton representing hospitality, and then after close you have Meta, Ford, Qualcomm, Teladoc, Etsy, and QuantumScape, the scape of the quantum. Meta expectations are pretty damn low, and it's certainly choosing a tough time to invest in a heavily futuristic metaverse project that is going to be a money loser for the foreseeable future. And overall, of course, the ad spend business is bad for reasons I mentioned earlier. Ford, there was a survey we talked about last week where some market participants were trying to find good deals in cheap cyclicals, including specifically cheap autos, and Ford is probably going to be one that is going to be very, very likely to fit that. I'm not convinced that we've bottomed. I think there's going to be more sell-off opportunities in the future in Ford and a lot of these companies. But there is that new wave of trader that's thinking, hey, wait a second. If the Fed is not going to be more and more aggressive heading into the fall, and instead they're going to be cutting back, then the bottom could be within the next quarter or two. And thus they're scouting out deals. And I think that if that narrative does play out, then Ford is probably going to be one of the best deals. Thursday, you have the array of Till, Pfizer, Valero, Southwest, MasterCard, Hertz, but the main ones that folks are going to be watching are Apple and Amazon. Apple is down year to date like everything, but you saw a pretty strong bounce the last couple of days or last couple of weeks. But they have already talked about slowing hiring and spending into 2023. And why do that? Why even talk about that ahead of earnings if your company isn't projecting an even stronger overall pullback in consumer activity, right? Amazon, big dog, e-commerce king, is king of a slowing down industry right now. Let's see an update over there. But overall this week, you have a lot of big players. You have mega tech reporting, you have domestic automakers, you have growth tech like your companies in Spotify, Shopify, Roku, Teladoc. You have manufacturing with Boeing, you have consumer defensive, McDonald's, Coca-Cola, Kraft Heinz, and so forth. So this is a week where you have some of the top representatives from some of the most important companies reporting, and all reporting in the span of really these 3 days. And with earnings, I have to tell you, I'd be shocked if you don't see at least one major company give a market rug pull this week. Some chance that it's Alphabet, Microsoft, Visa, maybe Apple. I'd say Meta, but they've already rug pulled a lot in the past, and I think that expectations are too low to really cause a bigger rug pull. And you wonder what happens with these companies that rug pull the overall market and cause a tanking in the overall market for like a week. Like, for example, Netflix. What happens with them when they're not doing as bad as expected? Obviously, Netflix had just been obliterated on the last 7 months, and expectations were as low as they could get heading into earnings last week. And all of a sudden, guess what? Well, Netflix actually lost half as many subscribers as people had thought they would. And it's great. Hey, maybe you lost 1 million subscribers instead of the 2 million that we thought you'd lose. But ask yourself, what did that really do for the stock price? You had this dwarf-sized stock rally that already started giving back some on Friday. Why did it only rally this much, Charlie? Well, think about all that capital that ran away from Netflix over the last 8 to 9 months. They sold out because they saw this company dwindling and dwindling and dwindling. The overall growth trajectory was negative. If you sell out of a company because the growth trajectory is something that you don't want to be a part of, just because it's losing at a pace that's half as bad as what you thought it would be losing at, doesn't make it suddenly a buy. Very hard to get people to buy back into companies that have very, very low prospects for a short-term or at least a medium-term rebound. So really what you get with these little rallies are those very, very short-term momentum-based traders, probably hedge funds, that are basically just trying to play that short-term comeback. And eventually once they're gone, that rally will probably just evaporate again until Netflix actually shows that they can rebound their overall business, right? And I think that's kind of the problem that we are seeing with the broader market. People are still in this phase of not believing in any growth turnaround or really seeing any evidence for one, because we still have a lot of the worst negative macro factors ahead of us. So it's very, very difficult for them to maintain these rallies outside of just these little contrarian rebound bear market rallies. And sometimes I'll read comments and they'll say, oh, Charlie, the stock market went up this week, or, oh, if the stock market goes up 2 weeks in a row, well, that's suggestive that we're going back to all-time highs. And it's like, well, no, unfortunately, if you look at a lot of the previous rallies throughout market history, the previous bear market rallies, they could last up to 6 months. So even if you do get a period of time where you have like 2 months where the market's just rallying like crazy, hey, great opportunity for traders, great opportunity to make some moolah. But if you want to look at an overall trajectory, that's definitely not a symbol that, oh, the bear market's over because the prices went back up for a short amount of time before the Fed decided to bludgeon it again because they realized that they were underreacting to this inflation problem. It's hard to say how things are going to play out, but hey, that's just what we're looking at right now. Now, in terms of the GDP report, this comes out July 28th, which is Thursday. Now, the Q1, of course, was contractionary. If we get 2 quarters in a contraction, then boom, we are declared in a recession. The Atlanta Fed's calculator is still predicting a contraction for Q2, now negative 1.6%. So odds are leaning in that direction. We'll see what actually happens. I don't know that the actual declaration of a recession is going to be that big of a deal for the market. I think what markets are really, really concerned about is, number one, what the Fed is going to do heading into the fall, which I think the market is starting to expect them to be a little bit more dovish. And then number two, what companies are going to be doing. And I think markets are probably going to start anticipating a pretty big earnings recession. And they have not anticipated that to the extent that people are acting like they have. Anyways, folks, that caps off this video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our step-by-step lessons, private chat, daily morning briefings, as well as our full price target list, I'll put a link down to ZipTrader U in the description. If you want to get up to 10 free stocks with Moo, make sure to do so before the end of the month with our link down below. They can be valued all the way up to $2,500, so make sure to check it out if you haven't already. Have a good one, folks. Make sure to hit that ravishing subscribe button, and I'll see you in the next video.